Good morning, everybody. My name's Faye Howard. I'm a private client tax partner and I'm based in our Ipswich office, or more frequently at the moment, in my living room. And just in case anything does go wrong with the filters this morning, for the avoidance of doubt, I am not a cat. I'm going to start by looking at income tax this morning. There weren't very many announcements at all in relation to income tax in the budget, and that is what we would expect. At a time when income is quite scarce for a lot of people, it doesn't feel right to tax it. So what the Chancellor said was that in this Parliament, he's not expecting to make changes to income tax, national insurance or VAT. So what we have seen is a freezing of the personal allowance and also a freezing of the threshold at which higher rate tax becomes due. Now, when he said he wasn't going to make any changes, he wasn't kidding, because this position is going to be the same until the 5th of April 2026. So for 5 years, there's going to be no movement in the personal allowance or the high rate tax threshold. Now, in the UK, the rate of income tax that we pay doesn't actually compare too badly to the rest of the world, but it made us think, what is the effect of this fiscal drag? If you're an individual earning £50,000, which is the higher rate tax threshold, there or thereabouts, by the time we get to 2025-26, because you're missing out on what we would ordinarily have the inflationary rises to the personal allowance and high rate tax threshold, by 2025-26, you will be paying over £1,100 a year extra in tax. Now, these measures are set to raise just over £8 billion for the Treasury over that period. And when you consider that the cost of the furlough scheme to February this year is nearly £54 billion, it kind of feels a little bit like looking down the side of the sofa for a couple of quid to help towards the several £1,000s holiday. But I guess, as the saying goes, every little helps. It is, however, clear that tax rises are going to be needed, but they aren't coming from income tax, certainly at the moment. Other income tax announcements, there's been an extension to social investment tax relief, and I'm sure this is a very welcome extension to businesses in that sector. This particular relief encourages individuals to invest into social enterprise and charities, which gives them flexible source of funds. So I would imagine that, particularly at the moment when those services are in great demand, but funding is perhaps in short supply, this extension to this relief will be very welcome. Changes to interest relief. Now, this isn't new. We've spoken about this for a number of years now because it's been phased in over the past 4 years. But we have now reached the point of pain, point of maximum pain, really, for residential landlords. 2020-21 is the first tax return on which the relief for your mortgage interest is going to be given entirely as a 20% tax reducer. And that position will continue going forwards. Making tax digital is something we speak about every year. If you are already registered for MTD, for VAT, then fine. But if you haven't been required to register, you were probably expecting to be registered by the 1st of April 2020. However, that date has yet again been kicked down the road, and the government are very good at kicking that into the long grass. And we're now looking at a date for registration for income tax purposes being April 2023. Will it get pushed out further? Quite possibly, but we will update you, of course, as any further changes are announced. On to capital gains tax now. There was an awful lot of speculation in the run-up to the budget that there would be changes to capital gains tax, but actually we haven't seen anything. We already knew that there were changes to the way in which capital gains tax on residential property would be paid, because now, if we're disposing of a residential property, a UK residential property, we have to report that capital gain and pay over any tax due within 30 days of completion of the sale. If you are looking at doing this, however, the key is to plan ahead, because there are a number of registrations which have to be made which can eat into that time limit. So do let your advisors know if that is on the horizon. But in terms of capital gains tax going forward, what does the future look like? Well, in 1965, at the point at which capital gains tax was introduced, the then Chancellor, James Callaghan, said, "Gains confer much the same kind of benefit on the recipient as taxed earnings. The present immunity from tax of capital gains has given a powerful incentive to the skillful manipulator. And I imagine that at that point in time, a lot of tax advisors were patting themselves on the back for being skillful manipulators. In 1988, the then Chancellor Nigel Lawson said, when aligning the rates of income tax with capital gains tax, that there is little economic difference between income and capital gains, so income and gains should be treated along similar lines. And it seems that we are now coming back to that way of thinking. The speculation in the run-up to the budget about the possible alignment of income tax and capital gains tax rates stemmed from the publication of a report by the Office of Tax Simplification. In November 2020, they made 11 recommendations to the government as to reforms to the capital gains tax regime. I've summarised these recommendations on the next couple of slides, but there are a couple of things that I just wanted to highlight here. The first one is the potential alignment of the rates of income tax and capital gains tax, which of course, as you could imagine, is most likely to mean the increasing of the rates of capital gains tax rather than the reduction of income tax rates. But if that does happen, there are likely to be some reliefs to come in to make up for some of that increase. However, I think it's fair to say that an overall increase is to be expected. The second point I wanted to make is just with regards to what happens on death currently. At the moment, when somebody dies, their estate is valued for inheritance tax purposes. Any inheritance tax due is calculated and paid over to HMRC. The assets are then distributed to the beneficiary, who inherits them at a rebased base cost for capital gains tax. So if you've got an asset that was worth sort of, let's say £100 when the deceased acquired it, and it's now worth significantly more, say £100,000, that asset will be rebased to £100,000 for capital gains tax purposes. And that does seem an incredibly generous relief, but it's very welcome. However, this may well be reformed in the future. Inheritance tax reliefs, there really isn't very much to say here, very much unchanged. The only real announcement was that the inheritance tax nil rate band and residence nil rate band will remain at their current levels again until the 5th of April 2026. Now, I love inheritance tax, I have to say, my mission is to get the light green section of this pie reduced, because this graph shows how much tax we pay here, inheritance tax, in the east of England. Inheritance tax is great because there's so much we can do to reduce it. So, as I say, my mission, I want to be standing here in a couple of years' time and seeing that light green section shrunk. However, we are potentially looking at some changes to inheritance tax in the future. Again, the Office of Tax Simplification made a report in July 2019 where they again made 11 recommendations. These are summarised on the next couple of slides, but there are three that I just wanted to pick up on quickly. The first one is the potential replacement of the gift allowances. Currently, we have an awful lot of small exemptions which, frankly, tinker around the edges of inheritance tax. So what we're looking at doing is potentially getting rid of those and replacing them with an overarching gifts allowance. I think everybody's probably aware of the 7-year rule when it comes to inheritance tax, which says that if you give something away, it takes 7 years to fall outside of your estate. And the proposal is that that 7-year period is reduced to a period of 5 years. And of course, the third change, which is also mentioned in the capital gains tax report, is the potential abolition of the rebasing of capital gains on death. So the final thing I want to talk about this morning is the support that's been made available in response to the coronavirus pandemic. As I'm sure you can imagine, the budget document was a very wordy document, but buried in the middle of it was this nice picture showing how much relief has been given by geographical region. And I just wanted to highlight here the amount of relief that's been received in the east of England, because it's great to see that relief coming to us. In terms of the support measures that are available, I'm not intending to go through these in any great detail because I'm sure everybody is very well aware of what is available out there currently, but I will just highlight that if you are looking at making applications for CBILS or bounce back loans, that the closing date for those is 31st of March, so the end of this month. Any applications will therefore need to be dealt with quite quickly. In terms of new measures, We've seen an extension to the self-employed income support scheme with a fourth and fifth grant, the fifth grant being affected by how much your turnover has reduced as a result of the pandemic. The great news for the newly self-employed is that anybody who started self-employment in 1920, they should now be eligible for these grants as well, because they will presumably have filed a tax return now. There's a restart grant scheme with grants of up to £6,000 for non-essential retail and £18,000 for hospitality and leisure, and that's per premises. We are awaiting more details on this, but we think that that's going to be based on the rateable value. There's a reduced rate of VAT for hospitality, business rates holidays for retail hospitality and leisure, and to replace the CBILS and bounce back loans, loans for businesses to reopen of between £25,000 and £10 million, and these are government backed. There's also an extension to the Vat Deferral Payment scheme. So if you deferred your VAT in the June quarter last year and were expecting to pay it this month, you can now spread that over the next 12 months interest-free, provided you let HMRC know you wish to do that by the 21st of June. Coronavirus Job Retention Scheme stays in its current form until the end of June, then a reduction from 80% support by the government to 70% for July and 60% for August. Finally, for those of you with employees working from home, this is something we get asked a lot. There aren't a huge amount of reliefs available, but you can either pay your employees £6 a week or they can claim tax relief on £6 a week from the government unless they can prove that their actual costs of working from home are substantially more. You can also provide them with the equipment needed to do their job, and this only covers things like computer, monitor, printer. Unfortunately, it doesn't cover things like desk, chair, and a nice swanky office in the garden. However, if you can get your employer to pay for that, I would suggest it's worth paying the tax on it. So in summary, very little to report in terms of personal tax, but we are expecting changes for capital gains tax and inheritance tax going forward. In terms of the coronavirus support measures, we are very much here to support you. We have been throughout this pandemic and we will continue to be so. So should you have any questions, please do get in touch either by contacting the office or by using the dedicated email address shown on the slide. That's it from me this morning. Thank you very much, and I will now hand over to my colleague Grant Buchanan to talk about the financial planning aspects from the budget.